Good morning and welcome from New York City. I am Kenny Polcari, your host of the party. And today is Tuesday, April 11th, 2023. And what is it that you need to know? Stocks advanced yesterday, right? As investors are betting that the rate hiking cycle is just about over. The NFP report from Friday does not surprise anybody at all. This week, we're going to get the latest CPI and PPI inflation readings, and earnings season begins in earnest on Friday. And what do we have for dinner tonight? We're going to have the shrimp scampi. We're going to get to that in a moment. Okay, so listen, the NFP report came in right in line on Friday, but by now you know that. There was nothing dramatic about it, right? Other than what we saw, the unemployment rate ticked a little bit lower, right? It went from 3.6% to 3.5%. Not what the Fed wants to see by any stretch. Everything else was not earth-shattering at all. Average hourly earnings, the yearly earnings came in line. Job creation came in line. Average hours worked in line. Labor participation rate, again, all in line. Remember though, JJ needs to see the unemployment rate tick up and not down. So this is going to present a little bit more of an issue for him as we move forward and he decides what's going on with the Fed. Economists agree that we're going to need to see the unemployment rate tick up to above 5% if he's going to be successful in taming inflation. And the fact that the unemployment rate is held near record lows after he has raised rates nearly a dozen times is not helpful at all to him. And that's what's going to keep the heat on the Fed. So once again, anybody who thinks that we're going to see rate hikes this fall, not one, not two, but three rate cuts coming, is really barking up the wrong tree, because wake up, not happening. I mean, the economy would have to implode at this point for JJ to consider stimulating the economy by cutting rates. And by all accounts, that does not seem to be happening, at least not yet. So look, stocks meandered all day long as the cyclicals represented by the industrials, the XLI up 0.9%, and the SMIDs, right, which are the small and mid-cap stocks represented by the Russell, but also by the IJJ and IJT, which rose by 1.25% and 1.4% respectively. They all led the market higher. Volumes were light, getting no help from Europe because those market centers were all closed in observance of the Easter Monday holiday. And so we tossed back and forth without any major moves in either way. At the end of the day, the Dow added 100 points, or up 0.3%. The S&P added 5 points. The NASDAQ lost 4 points, while the Russell gained 12 points, or 1%. And the transports were the winners on the day, adding 230 points, or 1.6%. Tech was mixed. Apple got slammed, down 1.6% after they reported that personal computer shipments fell sharply, while the semis rose after Samsung announced that they were going to cut memory chip production, right, as they try to control the semiconductor supply chain and the prices. The SOX, the semi ETF, gained $7, or 1.75%. That's just like when the Saudis told us that they're going to cut production, oil production, to try to control the price of oil, right? Oil stocks and oil prices shot higher after that announcement. It's that whole supply and demand conversation that you should have learned in Economics 101, right? Because it's a very simple conversation. The other broad S&P sectors ended the day mixed. Utilities down 0.2, communications down 0.2, while the healthcare sector, consumer staples, ended the day flat. And we saw gains in financials, consumer discretionary, energy-based materials, and real estate all ended just a bit higher. Value beat out growth, rising 0.7% versus a loss of 0.1%. Aerospace and defense names ended the day up 1%. The ETF ITA ended the day up 1%, leaving the group up 4.5% year to date, right? Think about the latest drama playing out across the South China Sea as Beijing threatens to take over Taiwan. Individual names rose even more. Raytheon up 1.3%, Northrop Grumman up 1.3%, L3 Harris up 1.1%, and Lockheed Martin up 1.4% on the day. This should surprise nobody. Look, we've been talking about how China wants to take Taiwan back, causing all kinds of chaos to the global economy, never mind the war that will surely result. This is not a secret. We've been talking about it for months now. Yesterday, Florida Senator Marco Rubio telling us that China will do this before the end of the decade. And I say, wake up, Mario! The end of the decade, come on. He's going to do it before the end of the Biden presidency because he sees the Biden presidency as weak. artificial intelligence gained ground, right, adding about 0.8%. C3.ai, which came under pressure last week after Carousel Capital accused them of accounting gimmicks, rose by 1%. Remember, Carousel has a very large short position in the name. The stock is up over 200% year to date, making it very, very, very uncomfortable for them. And so the accusation last week caused all kinds of damage to the stock. It lost nearly 40% or 12 points, as I reminded you that Carousel has a lot to gain by seeing the stock collapse. The question now is, was Carousel a buyer last week as the stock was collapsing in a drama they created? In any event, D.A. Davidson hosted a webinar yesterday featuring the CEO who clarified and disputed much of what was in that Carousel accusation and reaffirmed their $30 price target on the stock. So let's see what happens next, because like I said, it was up 1% yesterday on the back of that news. In the end, it is still all about the Federal Reserve. It reminds me of the 1992 Billy Clinton presidential tagline coined by Democratic strategist Jimmy Carter. It's the economy, stupid, and that's what it's all about right now. The economy. What the data tells us, how the Fed interprets it, how the Fed acts, and then ultimately how Americans act. At what point will Americans stop spending money, right, at the pace that apparently we're spending money? Because the data continues to tell us that Americans can't stop spending, right? Whether it's money they have or money they don't have, right? Last month, think all about the credit cards. We saw credit balances surge from $14.8 billion to more than $19 billion. That's a 28% increase in credit card balances in 1 month. Just saying. And the thing with revolving credit cards is that the rates are usurious, right? They're 20% plus rates. They're not uncommon. And if you miss 1 month or you underpay, the rates then surge closer to 30%. And then you know what happens? People stop paying their credit cards, and then you get credit card losses on revolving charge accounts. They begin to mount, and then you hear about the write-offs and the bad credit, and then you're going to hear it all during earnings season. And guess what? Earnings season is knocking on the door, right? It all begins this Friday, April 14th, and it's led by the big money center banks. JP Morgan, Citibank, Wells Fargo, Bank of America, Goldman Sachs. And then we're going to hear from the super regionals, and after that, the regionals, right? So pay attention to what the C-suite says about the loan loss reserve account, because if they ramp up the allocations to these accounts, and they will, that speaks volumes to what these banks think is about to happen to the economy and to debtors, right? Okay, so that's going to be very interesting, and it all starts this Friday. In addition, we're about to get hit with 2 of the latest inflation reports, right? Wednesday brings us the CPI, which is the Consumer Price Index. It's all about the consumer. That's due out Wednesday morning at 8:30, and it's expected to show a month-over-month rise of 0.2% and a year-over-year rise of 5.1%. But when you look at the core, you see something even a bit more disturbing. The core rate's expected to rise by 0.4 month-over-month and 5.6% year-over-year. The core rate is the rate that you would expect to be even lower than the top line rate, but all that tells you is that the core inflation, the stuff that you need and I need every day, remains strong. And while it's expected to be lower than last month, it is still sticky, and sticky is the exact problem for the Fed. On Thursday, you're going to get the PPI, which is the Producer Price Index, which is the inflation at the producer level, and it's expected to be lower this month. And that's good, because it is those prices at that level that ultimately get passed on to the consumer. It usually takes 3 to 4 weeks. So a declining PPI should equate into a declining CPI in a month and a half. And that's exactly why I see the Fed raising rates by 25 basis points this month, and then pausing at that level, which takes the terminal rate to 5 to 5.25%, to see then what the CPI does next month and then the month after that. Remember, many economists tell us that the terminal rate has to be above the inflation rate in order for it to slow inflation, right? We're just about there. And while the inflation might be just a hair above the terminal rate right now, that may change next month, and that's what is going to allow the Fed to hold the line. Now, if inflation fails to continue to decline, then the Fed is going to be forced to make a new decision and start raising rates again. Yet, if inflation does continue to decline, then the Fed can hold steady and be patient until they see inflation hit their target rate of 2%, which is what they've been saying all along is what they will do. That is their target. We're still a far way away, but we will get there in time. Bond yields continue to hover around the most recent levels, and they remain inverted, and they're proving to be a headwind for investors, right? Especially as we wonder about the length and the depth of the coming recession. The two-year bill is yielding 3.98%. The 10 years yielding 3.38%, while the 3 and 6 month bills are kissing 5%. 30-year fixed mortgages are now running at 6.7 to 7%, which represents a 133% increase from when Joey took office 2 years ago. Eco data today includes nothing that's going to move the market, so pay no attention. There's one report out, the NAHB report's not going to move the market. This morning, U.S. futures are up. Dow futures up 70, S&P's up 12, the Nasdaq's up 44, the Russell's up 5. Investors are now focused on the upcoming inflation reports that I said are due out later this week. The sense is that the Fed's tightening cycle is about to come to an end, and that would be a positive. In addition, we've got the start of earnings season, like I said, which begins on Friday, and that's sure to be interesting in light of the banking crisis that happened just last month, along with the tightening of credit conditions across the spectrum. So it's going to be very interesting to listen to what the C-suite says about the future. European markets this morning are open, and they are higher, all up about 0.5% across the board. Remember, yesterday we closed. Gold, which rocketed higher last week and then retreated as many traders booked some profits ahead of the long holiday weekend, is on the move up again. Gold's up $15 today, trading at $2,020 an ounce, betting that the May rate hike will be the last, which does not mean that June or July becomes a pivot and a cut. It just means that they've paused. It's also the ultimate store of value. Look, gold is gold, period. In any event, we're now in the 2,100 trading range for gold. And if the economy continues to weaken and the Fed pauses, then gold will have more room to run. So sit tight, sit back, and enjoy the ride. Okay, so look, the S&P 500 closed at 4109 last night, up 5 points, leaving it just below the most recent high at 4128. It feels like the market wants to go higher, as many now expect the end to the rate hiking cycle, right? And it wouldn't surprise me if it did. Watch for 3 Fed speakers today: Chicago's Austin Goolsbee, Philly's Patty Harker, and Minneapolis's Neely Kashkari. What will they say about future rate hikes and the state of the economy? Now look, if the market backs off, I suspect that it's going to find plenty of support at the trend line, which is 4,029. If it advances, it's going to find plenty of resistance at 4,200. So for now, we remain in the 4,025, 4,200 trading range. Okay, so now, what are we having for dinner? We're going to have the shrimp scampi, which is a very easy dish to make. Although it sounds more complicated than it is, you can make this dish in about 15 minutes, right? And everyone who has it is really going to enjoy the fact that you made it for them. So for this, you need just a couple of things, right? You need 1 pound of large, clean, deveined shrimp. You need butter, olive oil, garlic. You need lemon, white wine, chopped parsley, salt and pepper, toasted breadcrumbs, and you need a pound of linguine, and you need some fresh grated Parmigiana cheese. You want to start by putting a pot of salted water on the back burner, bring it up to a boil, and then when it boils, you can add the linguine to it, right? So it's going to take about 10 minutes to boil. It's going to cook it for about 8 minutes. It's going to give you enough time to, in a large sauté pan, you want to melt the butter, you want to add a splash of olive oil, and then add the crushed sliced garlic. Saute it around, keep the heat on medium so you don't burn the butter or the garlic. Now you're going to add the juice of 1 lemon. You're going to complement that with about 1/4 cup of white wine. Use your favorite, mine is Pinot Grigio Santa Margarita. Put that in the pan, bring it up to a boil, and then bring it up to a boil so some of the alcohol burns away, and then add the shrimp, salt and pepper, and saute it quickly until the shrimp are pink on both sides. No more than 5 minutes. You don't want to overcook the shrimp. Now strain the pasta, reserving a mug full of the pasta water. Add the pasta directly to the saute pan. Mix it all around. Make sure that you mix everything around. Let the pasta's going to suck up the sauce. So if you need a little bit of the pasta water to re-moisten it, add a little bit of the pasta water. Now you want to immediately serve this in warm bowls with some toasted breadcrumbs on the top, and always have fresh grated Parmigiana cheese on the table for your guests. In any event, look, it's Tuesday, it's morning. I'm here at the New York Stock Exchange. Until tomorrow, take good care.